Join us now, Evan Brown, UBS Asset Management, head of multi-asset strategy. I said off camera that a lot of the things that you're positing here are similar to what Tom Lee just said. Maybe you didn't see him, but maybe we've seen peak volatility, but uncertainty still reigns supreme at this point.
Yeah, I think the days of big spikes to 60 and 5% daily moves are probably behind us after Liberation Day, and I think we're now in a de-escalation mode when it comes to the tariffs and such.
That's the part that I thought was very interesting. You think that de-escalation, even with China, you say the Trump administration appears to recognize tariffs are unsustainable, and he's paying attention. He's more sensitive to the state of the bond market. So you think he hears this stuff? He hears the murmurs.
He hears. I mean, this is what he said when he backed down on Liberation Day. Is he said the bond market was getting a little bit jittery, and then it was a beautiful bond market after he changed policy. I think. We've talked about what the put is for the administration, and it's not on the S&P. I think it is on the bond market. They are conscious that they want to lower the cost of living on Americans, and they know politically that if you have mortgage rates start spiking even above where they are, if we're getting to 7.5, 8%, because the long bond is moving, that is a big problem politically with them across the spectrum.
So, I mean, that would be the weirdest method to the. Then we talk about method to the man. I'm glad Shakespeare lived because we use a lot of his expressions. But if he were to slow the economy, which causes rates to come down and inflation to be lower than anticipated, and then back off on the tariffs, is that an even trade to have a suboptimal GDP number or even a recession to affect those other goals? Is that what he's doing?
It's a good question. I mean, if you want to get, before we had all the tariffs coming in, we did have bond yields coming in lower, just on the idea
below
that
4% at one.
Yeah, on the idea that organically the U.S. was going to be cooling down. You had DOGE, you had government job cuts, you had immigration slowing down, and so they were getting there. The challenge is that with the tariffs, which have increased inflation risk, as well as on some level alienating some of the major foreign buyers of long-term Treasury bonds, that's created an issue for him, and I think that's one that the administration is and has to be sensitive to going forward.
You think that Jay Powell finally cuts rates sooner than people thought, or more than people thought? Is he going to have to?
He will have to cut rates, but I think he has to be hawkish before he gets dovish. I think he needs to show we're on top of inflation expectations. We're going to be over the coming months annualizing inflation, above 3%, potentially above 4% because of the tariffs. And so, it's hard as a Fed chair to say, hey, we're cutting rates, and by the way, we have 4% inflation right now, double the target. So they will, even amidst that inflation, cut rates only when they start to see real weakness in the real economy, and we have not seen that yet.
What about?
You really think that that's the choice they'll make? If that inflation is not going to be the primary focus, that in the end it's the jobs market that wins out?
I do. In the end, yeah, because the traditional way that the academic way of looking at these things is the tariffs are a negative supply shock, so they boost inflation, they reduce growth, but that inflation hike is a one-off. It's a temporary rise in the price level as long as inflation expectations don't get out of control. And so if they've managed inflation expectations by sounding hawkish at first, and then they've managed that, and then they see the growth weakness, then they can go ahead and cut rates.
So this actually is good news for Kevin Warsh.
Yeah.
Because you'd want to look like you're hawkish and then be dovish.
That's right.
If you're suggesting that's what he's going to be.
Yeah, look, I mean, I think the worst case scenario is the Fed, if the economy just looks okay, looks resilient, and then inflation, spikes to 4% or so, and then the Fed's cutting rates in that scenario. That is a very bad situation. That's where you get those kind of medium-term stagflationary concerns a la the 70s, where the big problem there was inflation expectations really just getting out of control, and you want that, you need that to get contained.
Earnings have been okay, but the outlook's murky, I guess. And I don't want to put words in your mouth, but we're out of time. So just,
yeah, I mean,
so just say yes.
Yes, Q1 earnings solid, but obviously very murky going forward.
Okay.